So the wine market in general, and the reason that it has become of interest to investors, is the fact that you have iconic wine labels that are recognized around the planet. And the fact is that every time a bottle is consumed, there's one less for the rest of the world to buy. And what people have realized is that this is something that isn't new. It's the most simple economic process, that if there is demand and supply diminishes, price has only one possible route, which is upwards. People are concerned that wine is a new invention in terms of investment, but I love the quote from the fact that when Thomas Jefferson was the first American ambassador to France, I think 1794 was a year, he wrote a note to his merchant saying, "I'd like some more of that stock," and the merchant replied, "Of course you may have some, but the price has shot up." It rose because the merchant was running out, as simple as that, and he knew the demand continued. So nothing in that sense has changed at all. The world, however, did change quite dramatically, I'd say, in 2012, where wine has always been deemed completely uncorrelated to other asset classes, almost completely. I think we used the term weakly correlated. In 2012, I'm afraid the economic cycle was too strong even for wine, and people's appetite to return to cash was exceptional. And yet people look at the wine market and say that it was extremely badly affected during that time, and the Livex index, the London International Vintners Exchange indices fell. They're listed on Bloomberg, and it was plain for everybody to see what was happening in terms of their outward numbers. But if you look deeper into the situation, rather like equities where you have banking, pharmaceuticals, oil, it wasn't every single asset class that fell. And if you take wine as a whole, pretending that it was like gold, i.e. every ounce of gold is the same as the other, then it's a mistake, because during this period of 2012, the economic decline influenced most the wines which were not consumable, i.e. young vintages of very expensive wines, for which there was no secondary demand, and unlikely to be so until the wine became consumable. So 2012 was interesting, and our investors were relatively well protected by the fact we've always, firstly, aimed for older stock, and secondly, not only aimed for the first growths, the top wines of Bordeaux, in terms of an investment vehicle. 2013, actually it was November of 2012 where the market sort of got to a point beyond which it was unlikely to fall any further, the wine market in general. And this was partly influenced by the fact that some wines had become affordable to the man in the street, and if a larger number of the population are able to drink and try these wines, then the influence is very swift, because they buy them and they're no longer on the market. The next person who comes to the table has to pay a bit more, simply because the supply is dwindling. So that happened in the middle of the month of November last year, and for the first quarter of 2013, the rise has been approximately 10% increase in values of the low point. And what is the influence? The answer is manifold. Partly the fact that some economies are not as badly affected as some people thought they were. And the influence of Asia is very significant in this respect, and partly because, as we mentioned, when things become inexpensive, lots more people are able to try them. So the outlook is quite interesting, because the economies of South America are looking remarkably strong. Japan has actively announced that anybody sitting on cash is going to be heavily penalized. And we know that there is just finite supply of this stock. Asia, we've mentioned, is very strong. Europe is actually consuming as much as it ever did. But the probably strongest influence at the moment is the fact that America, for the first time in 7 years, have become net buyers of stock rather than sellers.
What are the ways that investors are able to invest in wine as an asset class?
The commonest route, the most common route to investors seems to be the wine merchant. And the reason for that is that ever since wine investment became a little bit more mainstream, starting back in 2003 when I was first involved in it in formal ways, setting up formal funds, ever since then, the merchants have added a wine investment tab to their websites. Now, the conflict of interest is that the merchant is selling you something that he has in his cupboard, and he's selling it to you at a margin which is undisclosed. And what we say is that if you're going to invest in anything, you have to buy at the bottom of the spread, and you need to have somebody who will tell you what the margin is, but charge you a transparent fee so that you know what you're, well, firstly, that you're buying at the right price, but secondly, you're not paying somebody an enormous sum to do so. So the merchants have a large share of the market simply because they exist in great numbers, and many of them have known relationships with the individuals who become investors. The next route is the auction route, and we always say that's a little bit risky, partly because you have to be absolutely certain of provenance, and the auction houses are doing a fantastic job to guarantee that. But the real problem is that you're in an auction room competing with other members of the public. And there is something unusual about the concept of winning a victory by achieving a highest price in a lot, which is great in terms of the feeling of satisfaction, and hopeless in terms of investment returns. So auctions are a route, but we advise caution as far as that's concerned. You have to know what the global price is for that product, rather than paying what you feel like paying on the day. And then there are fund managers, and of course I am one. There are not that many in the world who are purely fund managers. And the answer and the reason for looking at us is firstly that we have a vested interest in success. An awful lot of fund managers in all areas, but in wine in particular, gain from success in terms of returns. They share the upside. So that is an important point, but what it means is that we're stock picking in order to achieve results. And the real thing about fund managers and wine as it stands today is that any successful industry attracts the criminal element. And I'm sorry to say that there have been all sorts of scams that have existed, but I sort of feel sorry for people who get caught up in them. But why would you hand over money to somebody who's given you a cold call saying, I promise you that the returns on wine are stunning? Everything that they say is correct about wine. The simple thing is that they are shady outfits. So never send anybody any money until you know an awful lot about them. So wine investment, I think that the safest route to great returns is to go through a fund manager. So the global turnover in fine wine is recorded by Livex, who have access to extraordinary volumes of data, standing somewhere between 6 and 8 billion sterling per year. So an awful lot of wine is traded. The reality, though, is that Livex, as an exchange, probably turns over, again, they won't publish the figures literally, but it's somewhere we estimate between 80 and 100 million a year. So Livex, as an indicator of what's going on in the market, we have in the industry, the wine industry, found to be incredibly useful. But it isn't the whole story. And what it does is it shows what 400 trading members are prepared to pay each other for stock on any given day. And this sort of raises the question of liquidity. If very large funds are trying to sell enormous volumes of stock, then Livex probably isn't the sole solution. There are traders all over the planet with access to enormous customer lists who will take very significant volumes at different times. But the reality is that wine, because it is a commodity and because it is recognized, has a mid-price, a level at which it's believed it should be traded. But if you wanted your cash in 10 minutes, then actually Livex will find it for you if you put the offer on at a significantly low price. If you want to achieve a little bit more, then putting it on at a higher price may take you a week to sell the stock, and so it continues. We advocate, when it comes to moving out of portfolios, that we go to the end user as much as we possibly can, because that's the highest part of the price spread. But Livex is a strange indicator also of what's going on in the market in terms of the number of trades. And when Lehman's fell out of bed in 2008, there's a paper I would like Livex to write, which is that equities on the FTSE 100, for example, that were completely unsaleable, and all that happened was the prices ticked down. Whereas at exactly the same period, lasting 2 or 3 months, there was a recognized increase of actual trades on the Livex exchange. So people always talk about equities having instant liquidity and wine being a risk. Oddly enough, wine does have genuine liquidity in the right circumstances and at the right price. So we look at Livex on a daily basis. as an indicator of everything that's going on, but we accept that it is not the sole solution to the global turnover. The wine market was significantly influenced in Asia. Actually, it began in 2007. Duty went from 80% to 40%, and then in 2008, from 40% down to 0. So Hong Kong, as a hub for wine, was on the map and has remained so. As a stepping-off point, a sort of a mid-point for wine to travel to Greater China, Hong Kong has had a significant influence. And during the regime change, which finished in November of 2012, there was a stuttering in terms of how much wine was crossing the border, but it seems that has reignited again. There is an increase in demand. And we, in the wine world, look at China in the sense that we know that the annual consumption per person is about 0.4 of a bottle, and we know that if it rises as much as 2.5 of a bottle, that the increase in demand in terms of number of bottles is absolutely monumental. So wine has an enormous future as far as Hong Kong and China is concerned, and we don't think that that is going to change pace. But what we do think is that there's significant influence from other parts of the planet, equally other parts of Asia. Singapore is a phenomenal hub, and every single five-star hotel has to serve the sort of wines that people would like to use to honour their guests. Japan has actively announced as a government that they don't want anybody to be sitting on cash, so tangible assets are becoming extremely interesting to them. And they were responsible for monumental price rises in wine during the mid-90s up until 97, when of course they had a bit of a crash. We see strong return from Japanese investors to wine over the coming months, having a significant influence on the stock that could be distributed to Hong Kong or China. And then there is India. India is in an unusual situation because their duty levels are very high. There's a monopoly on import of wine through the hotel groups, but the government has announced its intention at some point to change duty rates to those similar to European rates of duty on wine. If that happens, you introduce to the wine market a population who is already familiar with European ways of consuming wine, but have never taken their own portfolios home to their home country because of the import tax, but who have shared, shall we say, with an ever-growing middle class, upper middle class and ultra wealthy seam, the fact that wine is a very useful thing, just really to sort of demonstrate that you're sophisticated, that you know what you should be serving. And once again, it is an enormous market where if it turns its attention to wine, the finite supply is going to be given a real challenge.